SoFi is facing its largest challenge ever since becoming a public company. Let me show you a sneak peek of exactly what I'm talking about.
And tonight I've got another one. Not to be confused with JP Morgan. It's a little out there. It's SoFi Technologies.
That's Jim Cramer saying that SoFi is a great buy right now versus all of the other regional banks. Now, if you don't know Jim Cramer or the curse that this man puts on stocks, whatever he says is gold is quite the opposite. Now, obviously, this isn't SoFi's biggest challenge ever. I will be going through all of them in my video today, but first, let me just show you some of Jim's recommendations throughout history. First off, in 2008, he recommended that we should buy Bear Stearns and that it's actually a strong company. That company later collapsed. Wachovia, that company, once again, said it was very strong during the 2008 financial crisis. Absolutely not. The company collapsed. Then, General Electric, before the largest decline in the stock's history, he said it was a smashing buy, okay? Then, it absolutely collapsed, not actually fully into bankruptcy like the other two, but then also, nations can even go the opposite way with Netflix in 2010. He said was a sell due to large competition. That stock went on to be one of the best stocks of the decade. But this is just the start. This list is filled with insanely terrible recommendations. First Solar back in 2011, Zynga back in 2012, JCPenney in 2012, Hewlett Packard 2012, GoPro 2014, Valiant Pharmaceuticals 2015, Chipotle Mexican Grill 2016, and we are just getting started, okay? Going into more recent history, you can even see that he recommended 1 month before the collapse of Silicon Valley Bank, it was a smashing buy on his list for a price target of $330. Today, it's zero. Okay, enough about Jim Cramer. Let's talk about SoFi now. But I mean, come on. This guy has an inverse Cramer ETF where they're outperforming the market by just betting against what he's saying. But SoFi is not opposed to large challenges. Think back to one of the largest ones that SoFi has ever seen, and that was whenever back in 2020, SoFi's student loan refinancing business, which was their entire business, completely went up in flames whenever the Trump administration had canceled student loan repayment plans. Whenever this pause was placed, SoFi's entire business practically, disappeared, and they had to pivot to personal loans, home loans, investing accounts, and checking and savings. And they're bigger now than ever before. That put a massive damper on the company for a while until people realized how well SoFi could pivot. But now in 2023, today is a completely different beast. We're looking at 5 major challenges for SoFi, and I'm going to talk about all of them. We're talking about stock-based compensation, profitability, diversification risk, deposit growth, and delinquencies. Starting with stock-based compensation, SoFi's percentage of stock-based compensation versus their competitors was unbelievably high whenever compared to how much revenue they were actually bringing in. This dilutes shareholders and puts a negative downside on our actual GAAP profitability whenever looking at the accounting side of the business. And speaking of accounting, the methods used whenever actually calculating full stock-based compensation are so complex that the average investor and even some analysts completely mess it up whenever calculating how much it's truly costing the business. A friend of the channel, Christopher Hager, actually did an interview with the chief financial officer of SoFi to actually talk more in depth about the actual stock-based compensation. They spoke about how the stock-based compensation of the past few quarters has actually gone down quarter over quarter, which actually means that we're making great progress, even though revenue had continued to climb. SoFi's CFO also said that he expects this number to get down to the single-digit percentiles, and that's going to be amazing progress whenever we're comparing to the actual competitors. But it's also important to understand that about 1/3 of all of the actual stock-based compensation that has been issued at SoFi is also performance-based stock units that are tied to the price of the stock. What this means, let's say we take the CEO of the company, Anthony Noto, for example. Well, he's only really going to get paid out a large portion of his actual earnings if he makes the stock go to $25, $35, or even $45 per share. So yeah, he'll make a ton of money if the stock goes to $45 a share, but that also means that investors like myself are going to make a ton of money if that actually happens. So to pay Anthony Noto for his services would be something that I'd be very happy to do. SoFi CFO Chris Lapointe had also pointed out that if it doesn't hit $25, $35, or even $45 by Q1 of 2024, these options are actually going to start to roll off and are not going to actually be paid out at all. So although that it was a real expense that was written down on our profitability in 2021, it's not actually a real charge because it will never have been paid out at all. This could potentially lead to profitability coming much sooner than people actually expect. Now, speaking of profitability, it's important to understand that what we're actually talking about is GAAP profitability. We are making money after all of our cash charges, but those don't include non-cash charges like depreciation and amortization and stock-based compensation. Now, I don't want to downplay the whole importance of GAAP profitability. That means it's a very strong investment for investors, right? But it doesn't mean that the company's not going to survive. Plus, SoFi is expected to hit GAAP profitability by Q4 of 2023, less than a year from now. And this is based on very conservative metrics that if they outperform in any of these categories, which they usually do, I assume that it's actually going to come in Q3 of 2023. Now, on to diversification risk, where SoFi has made massive strides, but it is still true that we make roughly 70% of our revenue just from personal loans. Now, this is a big problem. SoFi kind of went from being just a large student loan company to being a large personal loan company. But SoFi didn't really have a lot of options, and personal loans was a booming category. So Anthony Noto thought, make hay when the sun shines. But that doesn't mean that SoFi isn't trying to diversify as best as they know how to, right? They even acquired Galileo back in 2020 after the actual student loan moratorium to try to make back a whole new business of going after financial services, but on the B2B side. They're fighting for student loans in court right now and just acquired a company called Wyndham Capital to actually get back their home lending platform. Just in 2022, SoFi had become a fully chartered bank. They had launched margin trading, even acquired Technisys to help out with Galileo. SoFi added after-hours trading, launched SoFi Plus, they added options trading, they even added buy now, pay later. And these customers are loving these new additions, as most of them are actually in the financial services side of the business, which is by far outpacing the growth of the rest of the company and increasing that amount of diversification from the business ever since they started doing this diversification. But now on to deposit growth. This one I think is an amazing topic right now because the Silicon Valley Bank collapse, Signature Bank collapse, all of these were based on deposit growth because really they didn't have any. A lot of people were taking money out and causing the banks to actually lose their liquidity. During a Bank of America conference with Anthony Noto, the CEO of SoFi, he actually explained that their deposit growth hasn't stopped, and even during this bank collapse, they were still growing as linearly as they were before. See, SoFi adds, very funnily, $2.3 billion worth of deposits every single quarter for the past 3 quarters now. They have an okay quarter, $2.3 billion. They have a great quarter, $2.3 billion. There's a banking crisis, $2.3 billion. And this is all because of the addition of SoFi Plus, which has been a miracle product that SoFi has launched that has allowed them to bring in so much more monetization to the company. See, the idea is that there's 2 types of funding for SoFi. There's warehouse facilities, which is pretty much a big credit card that the bank can use to go in and get additional funding to fund their loans. But then there's also, once SoFi actually becomes a chartered bank, they can use their own customer deposits to fund the loans that they give out. Well, now this is the amazing thing. Warehouse facilities versus SoFi actual deposits, they're actually 1.9% more expensive than their deposits, even though SoFi offers 4% to their customers. That's the real cost of having those deposits. It's actually considered a liability to the bank, but we go out and lend it out for 13% personal loans, and that's sort of how we make our difference. But like I said, 1.9% between warehouse to deposits is a big deal, and all of those savings are going directly to SoFi, and it also means that we can go out and just get more loans to increase our amount of monetization going forward. This is why we've been such a strong personal loan business, is because we've been able to get all these customers. If there's a want and a need for it, SoFi can go out and offer that, and it's making our loan book very large lately. This brings me into the biggest and most mighty problem that SoFi could face today, and that's delinquencies. Delinquencies for student loans and personal loans at SoFi are rising, which means that as we actually hold more loans on our book, we are going to be losing more money based on those amount of loans. Now, if you actually look at it of how much we're making versus how much we're losing, no, we are still very much in the positive, but it still does hurt, and it's worrisome if that number continues to climb. SoFi's way of fighting these delinquencies is anything but genius. They just go after really great customers. SoFi's average customer FICO score is 747, okay? And then their average income for their customers is over 160,000 for their personal loans. It's even higher, in the 170,000s for their student loans. This is important because your FICO score can be some of the best way to prevent any sort of losses during a large recession. Once again, Christopher Hager pointed this out on one of his Seeking Alpha articles. I'll link it down below. But what you can see back in 2007, during the actual great financial crisis, where we actually landed, which would be Prime Plus, SoFi's normal clientele in these high 700 mark benchmarks didn't actually default much even during the worst of times. So although there was a lot of delinquencies, it really wasn't from these higher end affluent clients. It was from very much the subprime category, which was really what made the great financial crisis as bad as it once was. Now, FICO scores are not a foolproof science, but this is why they actually backstop it with what's called leverage ratios. SoFi's leverage ratios are the measure of actually seeing how much losses they could actually absorb or the actual financial stability of the overall company if something bad were to happen. SoFi's leverage ratios measure a very specific purpose. How much financial loss could we actually absorb and also stay stable during a financial crisis? But back in 2008, this is what actually could have saved the financial crisis, was the leverage ratios, or the CET1 ratios is what they actually call them. Back then, the minimums were only 2% for banks to hold on to, which means that they could be very leveraged and have a lot of money out there with only a little bit actually, holding for collateral. Today, the minimum that SoFi is allowed to hold, regulated by the actual Federal Reserve, is 7%. Okay, which is a lot more, which means we have to hold on to a lot more reserves to make us safe. SoFi takes this one step further, and they actually hold on to 14.6% as of the time of recording this video. That's just for SoFi Bank, by the way. SoFi Technologies as an overall company holds more than 20% in terms of CET1 ratios in case something bad were to happen. This is far in excess of how much they actually need, and even much higher than all of the big banks. This is why I'm a believer that SoFi is doing everything right, and although delinquencies could be a real problem, we're still protected on the downside regardless. But those were all the bearish takes on the company. There is also bullish cases on the company, but you're gonna have to check out that video right there. Aside from that, thanks so much for watching, and bye for now.